Hi, I'm Frank Notaf, Chief Economist of CoreLogic. Interest rates have remained low for a considerable time in the U.S., and it is natural to wonder how much longer we may have such low rates. A partial answer came in mid-December when, after more than 7 years of a near-zero federal funds interest rate, the Federal Reserve raised its benchmark target by 1/4 of a percentage point. In mid-March, the Federal Reserve released an update of what the target funds rate should be in the minds of the committee members that set monetary policy. The update shows that most committee members expect, if the economy performs as they think it will, that the federal funds rate will be hiked an additional 1/2 of a percentage point later this year, probably in 2 quarter-point increments, and maybe raise the full percentage point in each of 2017 and 2018. December's hike in the federal funds target led many to expect that long-term interest rates would gradually move higher during 2016. Yet, during the first 2 months of 2016, long-term interest rates dropped by about 1/2 of a percentage point. Why would long-term interest rates decline while short-term rates have gone up? To understand why, keep in mind that the Federal Reserve can set the federal funds rate as part of its monetary policy. But the Federal Reserve has less direct control in determining the level of long-term interest rates, such as on 10-year U.S. Treasury bonds or 30-year fixed-rate home mortgages. Long-term interest rates are affected by the expected rate of inflation over the investment horizon and by the level of real interest rates. If inflationary expectations decline, then long-term interest rates will also move lower because investors will require a lower nominal yield to earn the same expected return after inflation. Likewise, if weaker demand for funds or an increase in the supply of funds leads to lower real interest rates, then nominal interest rates will decline. Since the beginning of this year, confidence in the U.S. economy coupled with concern over lower global economic growth has resulted in an increased supply of global funds investing in U.S. Treasury bonds, pushing real interest rates lower. Further, the relatively weak growth in the U.S. economy during the fourth quarter, which was estimated at the end of January at only 0.7%, may have reduced U.S. inflationary expectations somewhat. These forces will likely be temporary, and long-term interest rates are expected to gradually move higher in the second half of 2016. Thus, if you have been considering placing an application for a home mortgage loan, this is a good time to do so, as interest rates will likely be higher later this year. Thanks for your time. For more on CoreLogic's perspective on the U.S. housing economy, please visit the Insights area of CoreLogic.com.